So you watched the last video on 10 smart investing tips, and now you're sitting there like, Brett, what the heck? I need more. Don't worry, my friend, because I have got you covered. Today I'm sharing 10 more smart investing tips that will take your investing strategy to the next level. Plus, a bonus tip at the end that ties everything together. Now, if you missed the first video, don't worry. You'll still get massive value from this one. And heck, you can just go back and watch that video after you watch this one. Now, if you're newer to the subject of investing, then it can really feel intimidating. However, it doesn't have to be. These investing tips will help you grow your wealth and feel confident about your financial future. Let's jump into it. Tip 1, automate your investing strategy. If there's one tip that will change the game for you, it's this: automate your investments. This strategy removes the temptation to skip investing when things feel tight. Plus, it keeps you consistent, and consistency is the secret to building wealth. Here's how you can do this. Set up automatic transfers from your bank account straight into your investment accounts. Why? Because automation eliminates the need for willpower. You don't have to remember to invest or find the extra money. It just happens like clockwork. If your employer offers payroll deductions for a 401k, use it. If not, set up an automatic transfer to an IRA or a brokerage account on payday. It's a set it and forget it approach that works. Now, if you really want to take this to the next level, increase the amount that you automate every time you get a raise. This will help you invest more while keeping that crazy monster known as lifestyle creep at bay. Tip 2, reinvest your dividends. Dividends are payments made by companies to their shareholders as a share of the company's profit. They're essentially a reward for investing in the company. Here's where it gets really powerful. Instead of cashing out those dividends, reinvest them to buy more shares. This kicks off a compound growth loop. You're earning money on your investments and then using that money to buy more investments. It's like planting a money tree that grows bigger every season. Historically, dividends being reinvested accounts for about 40% of the total returns of the stock market. For example, if the overall market return is around 10% annually, roughly 4% of that could be attributed to dividends and their reinvestments. This highlights the power of compounding as reinvested dividends buy more shares, which in turn generate more dividends. Most brokerage accounts give you the option to reinvest dividends automatically. Now, unless you are using those dividends to live on, then turn that feature on and let the magic of compounding work for you. Tip 3, track your expenses. The less you spend, the more you can invest. It's really just that simple. Tracking your expenses may sound boring, but it's one of the most powerful things you can do because it reveals all of the hidden leaks that's in your budget. Every dollar that you save on subscriptions, takeout, or impulse buys can go directly into your investments. Take control of your cash flow. Use a budgeting app or some simple spreadsheets and ask yourself, where can I cut back to invest more? Small changes can lead to big results over time. Now, if you're looking for a really good spreadsheet tool to use, you can check out the link to my intentional spending plan tool that I've linked down below in the description. And heck, just because I like you, I'll give it to you for free. Tip 4, utilize tax-advantaged accounts. Do you want to give your investments a turbo boost? Then use tax-advantaged accounts. I'm talking about 401ks, IRAs, and Roth IRAs. These accounts offer massive tax benefits. With a traditional 401k or IRA, you can get an immediate tax break on your contributions, which means more money to invest up front. With a Roth IRA, you pay taxes now, but your future withdrawals are tax-free. Imagine pulling out thousands of dollars in retirement and paying 0 in taxes. Sounds really good, right? I personally love watching my Roth IRA account grow because I know that when I go to retire, I won't have to pay any taxes on that growth. If you have access to these accounts, use them. They're one of the most effective ways to build wealth faster. Tip number 5, don't let your emotions drive your decisions. I'll be straight up with you. Emotions ruin investments. When the market drops, people panic and sell. When the market is hot, people FOMO in at all-time highs. Both of these moves are mistakes. How many times have you met someone that said at one time they owned some stock, home, or crypto when it was low, but they sold it too early because they were afraid when the value dropped, only to see it skyrocket right after? The reality is, successful investors learn to manage fear and greed. Stick to your plan, even when it's uncomfortable. If you're putting your money into reliable investments, trust the process. The market will fluctuate, but over time, it trends upward. Don't let short-term emotions destroy your long-term wealth. If you'd like me to do a more in-depth video on how to keep from making emotionally driven decisions with your money, then let me know down below in the comments. Tip number 6, review your investments annually. The term set it and forget it isn't that literal. Here's a mistake I see people make all the time. People set up their investments and then forget about them for like 10 years. Don't do that. Life changes. Your goals change. You definitely aren't the person you used to be 10 years ago. Hopefully. Your investments should reflect those changes. Once a year, review your investments. Are you still on track for your goals? Do you need to adjust your risk tolerance or rebalance? Are there new opportunities that weren't available last time that you checked? Is one of your investments completely stale? This doesn't mean constantly tweaking your investments, checking your investment account 800 times a day like some anxiety-driven crackhead. But a quick review every year will keep you in control. Tip number 7, stay the course. When the market is down, it feels like everything is falling apart. You're not alone. Everyone feels that way. But guess what? The market has always recovered. Over the long term, it's trended upward. Staying invested is how you win. If you sell during a downturn, you lock in your losses. If you stay the course, you give yourself a chance to ride the wave back up. This is one of the hardest but most essential lessons for new investors. People who are extremely wealthy like to look at a downturn in the market as an opportunity to buy up investments at a discount. And you should look at it the same way too. Tip 8, watch out for fees. Fees eat into your profits, period. High fee investments may sound fancy, but they often perform worse than low fee alternatives. If you're paying 1% or more in fees, you could be giving up tens or even hundreds of thousands of dollars over your lifetime. Now, depending on your circumstances, you may be okay with that. And if so, then more power to you. But just know that that does not have to be the norm. Look for low-cost index funds and ETFs with fees below 0.25%. Over time, the savings from lower fees compound. More of your money stays in your account, working for you. When you're doing your own investing, you can look at something called the expense ratio. An expense ratio is the annual fee that a mutual fund, index fund, or exchange-traded fund charges investors to cover its operating costs. It's expressed as a percentage of your total investment. For example, if a fund has an expense ratio of, say, 0.5%, you'll pay $5 per year for every $1,000 that you have invested. Lower expense ratios are better because they leave more of your returns in your pocket instead of going to fund managers. Tip number 9, keep on learning. No one is born knowing how to invest. The best investors are the ones who keep learning. Every book that you read, every podcast you listen to, every YouTube video like this one adds to your knowledge. And with more knowledge, you make better decisions. Finance is always changing. There's always new tax laws, new investment options, new strategies. Stay curious, stay hungry, and stay learning. If you're wondering how to create a good habit of learning, I went over that in a recent video titled 7 Habits I've Learned from Wealthy People, and you'll see it linked somewhere above my head. Tip 10, watch out for get-rich investments. You see these all the time, especially on social media and in Reddit forums. People talking about what will be the next big stock or crypto, and how you need to get in now if you want to get rich. This isn't real investing. This is more like gambling. Some people, I repeat, some, meaning very little, will make money and the rest will either be stuck holding the bag or get totally rug pulled. It's happened to me before in the past. It's happened to many of my friends. This is FOMO investing and it never usually works out. The people that are in on these first need you to invest your money so that they can win. If no one else invests their money in these, then it goes nowhere. Real investing is about building wealth slowly over time. If someone guarantees big, fast returns, run the other way. There are no shortcuts. Focus on proven strategies, not hype. Okay, you've made it this far, so I'm going to give you the big bonus tip. That is, investing is a marathon, not a sprint. Building wealth takes time. It takes patience. It takes discipline. You don't get rich overnight. But if you stay consistent and stick to the principles I've shared today, you'll look back in 10, 20, or 30 years and realize that every small step you took added up to something totally incredible. I want to put it to you this way. Imagine that you're standing on top of a 4-story high building, okay? There are 2 ways to get down to the ground. You can either jump off or you can take the stairs. A lot of people think that investing can only be won if you jump off the building. This is the sprint investor, the one that is looking to get rich really fast. They choose to take the gamble that when they hit the ground, they won't be hurt. The person that takes the stairs is taking the less risky, yet more likely to succeed route. They are the marathon investor. They are the one who invests consistently over time and is more likely to build wealth rather than completely getting wrecked in the process. If you're serious about building wealth, remember this: slow and steady wins the race. Now, if you made it this far, then you might as well hit the like button and subscribe so you don't miss next week's video, which you definitely will not want to miss. And if you missed out on last week's video where I gave you the first 10 smart investing tips for beginners, then you can check out that video here. But Make sure that you click on it soon because it's going to be gone in 3, 2, 1.